For the first time, the average cost of a new car in the US has topped $50,000. That is in part down to tariffs, with experts warning of an even bigger hit on prices next year.
Something strange is happening at car dealerships across America. Lots that were overflowing 2 years ago are starting to fill back up. Prices that seemed unmovable are quietly coming down. And buyers who spent years being told to take it or leave it are suddenly being handed negotiating power they haven't felt in over a decade. On the surface, it looks like the market is correcting itself, returning to normal. But when you dig into the data, talk to the dealers, and trace every thread back to its source, a different picture starts to form. One that's far more complicated and far more concerning than a simple correction. Because the American car market isn't just adjusting, it's sitting at the edge of something it hasn't faced in a very long time. A perfect storm of debt, overcapacity, shifting demand, and an EV transition that nobody fully knows how to navigate. And the consumers caught in the middle are running out of options. To understand how we got here, you have to go back to a period that felt, at the time, like the industry's finest hour. When the pandemic hit in 2020, auto production didn't just slow down, it stopped. Factories shut. Semiconductor plants, which supply the chips that modern vehicles depend on, redirected their output. And by the time the world opened back up and demand surged, there was almost nothing left to sell. The result was one of the strangest market conditions the industry had ever seen. Used cars were selling for more than their original sticker price. New vehicles had wait lists that stretched months, and dealers, for the first time in decades, stopped negotiating entirely.
There's an ongoing semiconductor shortage or chip shortage that's impacting car production and vehicle inventory across the country. Steve Dawes is the UAW Region 1D director. He says they've seen over 150 layoffs due to the shortage, impacting people at some GM Flint plants.
It affected the engine plant over on Bristol and Vance Lake Road.
The chip shortage, combined with the February winter storm, also recently forced Ford to build F-150 pickup trucks without some computers. Dawes thinks they should start making the chips in the U.S.
Consumers paid, not because they wanted to, because they had no choice. And the automakers, watching their profit margins reach historic highs, made a decision that would come back to haunt them. They leaned in. Ford, GM, Stellantis, Toyota. Every major manufacturer looked at those numbers and concluded that the era of cheap volume was over. The new strategy was fewer cars, higher prices, fatter margins. It sounded brilliant on an earnings call. It looked extraordinary on a quarterly report. But it was built on a foundation that was already starting to crack. Because while manufacturers were celebrating record profits,
Toyota shrugged off the health crisis slump and global chip shortage on Wednesday, reporting that its fourth quarter operating profit nearly doubled since last year. The world's biggest automaker by vehicle sales also announced a $2.3 billion share buyback, and forecast annual profit will rise by 14% to pre-pandemic levels. It says that will largely be driven by renewed demand in its biggest market, the United States. Toyota predicts overall sales will grow 6.4% to 10.55 million vehicles for the year. Its shares rose just over 2% after the results were released. But it was a different story for smaller rival Nissan. Its shares tumbled around 10% after releasing weaker than expected guidance for the current fiscal year.
something else was happening to the people they were selling to. Inflation had spent 2 years quietly eroding purchasing power across the country.
We heard what London business people are saying, but from UK to US now, where inflation is rocking American consumers at levels not experienced in over 40 years. From the cost of renting homes, weekly groceries and filling up the gas tank, rising prices, they have hit US spenders for much of this year as many make adjustments. WION correspondent Susan Tehrani gets us this report from US. Take a look.
Inflation is rocking American consumers at levels not experienced in more than 40 years, from the cost of renting homes, weekly groceries, and filling up the gas tank. Rising prices have hit U.S. spenders for much of this year, as many make adjustments.
Interest rates had climbed to levels not seen in a generation.
Interest rates are moving higher again, increasing borrowing costs for consumers. Interest rates on credit card debt, home equity, and car loans will rise now that the Federal Reserve is hiking rates by another 0.75%. Chairman Jerome Powell says the Fed will continue to raise rates to tamp down inflation, which is at 40-year highs and hurting many.
My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation.
And the average monthly car payment in the United States crossed $500 for the first time in history. For many buyers, that number didn't just feel uncomfortable, it was simply impossible.
In this world of everything is more expensive, add a car payment to that. The average monthly note is now just over $700 a month.
New information shows in addition to paying more at the pump, people can expect to pay more behind the wheel. The average cost of a car payment is now more than what some people spend in rent.
And these rising numbers are filling many drivers with fear. WCIA3's Ariana Williams explains.
At $700 a month, the ability to afford a new vehicle is out of reach for most Americans. While dealerships are noticing fewer cars and less foot traffic, the auto body repair shops are seeing business like they've never have.
Not a lot of vehicles out there used vehicle-wise, and a lot of people now can't afford newer cars. So it kind of brings them a lot of anxiety when they do get in an accident. They're worried that if it does total out, are they going to be left with a check that isn't going to be able to cover the cost of a new car?
30% of Americans, according to financial surveys, don't have $400 available for an emergency.
To a recent Fed survey, 46% of us don't have enough money to cover a $400 emergency. I don't believe that, James. I'm sorry, but $400, half the population of America can't get together $400. Are you kidding?
Yeah, it's obviously, if true, it's a deep concern, and I think it may be when you look at consumer debt versus let's say the pre-financial crisis. In some ways, it's come down, but student loans has gone up. Auto loans now more defaults, so it's a fairly indebted consumer, even if maybe not quite the problems we saw 10 years ago.
It just sounds like an extreme thing to me that half the population can't get together $400.
And it does seem extreme. Obviously, one solution would be better paying jobs.
You can do the math on what a $500 car payment means for a household like that. And yet, the vehicles kept getting more expensive. The average new car transaction price in America climbed past $48,000. SUVs and trucks, which had become the dominant product for nearly every major manufacturer, pushed even higher. The automakers had looked at their best customers and built the entire industry around them. But their best customers were a shrinking group. This is the part of the story that most people miss. It's not that Americans stopped wanting cars. It's that the car industry stopped building cars that most Americans could actually afford. The sub-$20,000 vehicle has nearly disappeared from dealership floors. And the buyers who needed those vehicles didn't vanish. They just got priced out. Some went deeper into debt. Others held on to aging vehicles longer. And a growing number simply stopped buying altogether. If you find this kind of analysis valuable, consider subscribing to the channel. Each week we break down exactly how industries like this one actually work, behind the press releases and earnings reports. The inventory crisis didn't last forever. Production recovered, supply chains stabilized, and by late 2023 and into 2024, cars started showing up on lots again. Not a trickle, a flood. Dealers who had spent 2 years selling everything they touched were suddenly staring at 90, 100, 120 days of supply sitting on their lots. Carrying costs were climbing. Floor plan interest, which dealers pay on every unsold vehicle, was eating into margins faster than they could move product.
Yeah, Mike and Tiffany, and as such, he tells me he knows that the price of a new car is simply too high and out of the reach for many. Add in interest rates, which weren't a concern a few years ago, but today they are, and only adds to the cost. Well, this bill provides a little relief on that interest side, which can help lower the overall cost. Included in the One Big Beautiful Bill is the USA Car Act, providing relief from high interest rates for those who buy cars that were assembled in the U.S. by enabling those new car buyers to deduct the interest on their loans, a benefit above your standard deduction.
It applies to new American-made automobiles, and it's retroactive to January of this year. So anybody who bought a car this year, you took out a car loan, get ready to deduct that interest next year when you file your tax returns.
For the average consumer watching from the outside, this looked like good news, and in some ways, it was. Incentives started creeping back, prices softened on certain segments. Negotiation returned to showrooms that hadn't seen it in years, but beneath the surface, the math was getting worse, not better. Because the automakers had built their entire financial model around premium pricing. Now, with inventory stacking up and buyers still squeezed by high rates and elevated sticker prices, the only tool left to move product was discounting. And discounting destroyed exactly the margins they had spent 3 years protecting.
Nissan slashed its annual outlook Thursday after reporting a 99% plunge in first quarter profits. That's as deep discounting in the US shredded the Japanese automakers' margins. Nissan's shares fell following the results, which were far short of analyst expectations. Operating profit for April to June was just $6.5 million. That was just a fraction of the roughly $1 billion profit predicted ahead of the results. It marks Nissan's worst quarterly performance in more than 3 years. While global sales remained even year-on-year at 787,000 vehicles, the profit from those sales was hit by an increase in discounts and marketing costs.
General Motors quietly reduced its earnings guidance. Ford's electric vehicle division posted losses that ran into billions.
Auto giant Ford says it's taking a $19.5 billion write-down as it kills off several all-electric models. $8.5 billion of that hit directly related to the killing off of the company's next-gen EVs, including the all-electric pickup truck, the F-150 Lightning, that is set to become a hybrid. $6 billion tied to the scrapping of a joint EV battery venture with South Korea's SK On. Ford's commercial electric van project also abandoned. Weakening consumer demand and increasingly unfriendly policies from the Trump administration are behind the move. Sales of EV in the U.S. fell some 40% in November after a $7,500 consumer tax credit that had been in place for 15 years was allowed to expire. Ford's announcement follows a similar one from General Motors back in October. GM taking its own $1.6 billion write-down as it scales back its own EV ambitions. Ford, meanwhile, has lost some $13 billion on EVs over the past 3 years.
Stellantis faced a full-scale crisis when dealers in the United States publicly revolted, signing open letters and appearing in trade publications to describe what they called an inventory disaster.
And let's get back to one of our top stories this morning on the corporate front. Stellantis expecting a net loss of 2.3 billion euros in the first half. The car maker saw global shipments fall 6% in the second quarter to 1.4 million units, with U.S. shipments down by a quarter. It said actions are being taken to improve performance and profitability, with new products expected to deliver larger benefits in the second half of the year. Let's take a quick check of the European auto space across Europe and see how it's faring. There we go. A bit of a mixed picture here. Volkswagen eking out a modest gain. Mercedes is down. BMW also up by just a tad. But Stellantis, the company in question, is off by 2.3%, suggesting that.
And all of this was happening before the EV question was even fully on the table. The electric vehicle transition was supposed to be the industry's redemption story. The moment where legacy automakers caught up to Tesla, recaptured the future, and proved that 100 years of manufacturing knowledge still meant something. Instead, it became the most expensive bet in automotive history, with the outcome still unclear. Ford committed billions to electric vehicles. GM dismantled and rebuilt entire divisions. Every major player announced targets, timelines, and transformation plans that sounded visionary in press conferences and terrifying in budget meetings. The problem was demand. American consumers, as a group, were not adopting electric vehicles at the pace the industry had projected. Charging infrastructure remained uneven. Range anxiety persisted. And at price points that started at $50,000, $60,000, $70,000 for the most desirable models, the audience was still relatively narrow. Tesla, which had spent a decade building infrastructure and reducing costs, responded with something the industry didn't anticipate. They cut prices aggressively, repeatedly. And every time Tesla cut a price, the value of competing EVs already sitting on dealer lots dropped with it. For a dealer holding 40 electric vehicles at full sticker price, a Tesla price cut wasn't a competitor's marketing decision. It was a direct hit to their balance sheet. Some manufacturers began pulling back on EV targets quietly. Announcements about scaling production were revised without press conferences. Words like pivot and recalibration appeared in earnings transcripts where words like acceleration had been just a year before. And the consumer sat in the middle of all of it, watching prices shift, watching incentives appear and disappear, wondering whether the car they bought last year was already worth $10,000 less today. That feeling has consequences that go beyond individual transactions. When trust erodes in a market this large, behavior changes. Buyers delay. They extend leases instead of purchasing. They turn to the used market, which then absorbs the demand pressure and sees its own prices start moving in unpredictable directions. The ripple effects touch insurance companies carrying higher claims costs on vehicles priced above replacement value. They touch repair shops dealing with increasingly complex systems that require expensive diagnostics. They touch the 30 million Americans currently underwater on auto loans, meaning they owe more than the vehicle is worth. 30 million people paying every month on an asset that is worth less than the debt attached to it. That is not a correction. That is a structural problem that will take years to unwind. So where does this go from here? The honest answer is that nobody in the industry is certain, and the manufacturers who claim otherwise are the ones most worth watching closely. What we can say is this: the era of peak pricing is over. The automakers that survive the next 5 years will be the ones that find a way to serve a broader range of buyers, not just the top 20% who can absorb a $50,000 purchase without stress. That means smaller vehicles, more affordable trims, financing structures that don't require a buyer to commit 5 or 6 years of payments to basic transportation. It also means accepting that the EV transition will be slower, messier, and more expensive than anyone modeled in 2021. The companies that accept that reality and build for it will find their footing. The ones still chasing the margin structure of the pandemic era will find themselves exactly where Airbnb found itself when prices rose. But trust didn't follow, watching customers quietly walk out the door. The American car market is not collapsing overnight. These things rarely happen that way. They happen slowly, quietly, in 100 small decisions made over years, until one day the numbers no longer add up and everyone wonders how it got this far. The warning signs are already there. Whether the industry is reading them clearly enough is the question worth watching.